both Trump and Harris have been speaking about more spending at a time where the deficit is already at an extremely high level. Welcome to Key Points for November. Now this month was rather US-centric given the imminent election. But our first point is around US economic data, which are continuing to surprise positively. We look at the move higher in bond yields as a result of some of the pledges being made on the election campaign. And we turn our attention to the equity markets, where we think there's some signs of profit taking and perhaps a setback. Now, turning to the first point around the US economy. Numbers that have been coming out in recent weeks have actually been very much better than people had been expected. The US economy is continuing to expand at a healthy clip. If you look at the first chart I've got here, this is the Citigroup Economic Surprise Indicator. So looking at actual economic outcomes versus what economists on Bloomberg are expecting. And you can see that over the summer period, we had quite a lot of disappointment. Numbers were coming in weaker than economists had been predicting. But recently, really since September, we've seen this move markedly higher. And actually, the most recent data have continued to surprise very positively. As a result of that, people have been increasing their expectations for US growth. Certainly, we've moved away from any kind of notion of an imminent US recession. Now, if you look at the second chart here, this is a key component. This is looking at the labor market data in the United States. The red line is the unemployment rate. And you can see that, yes, that has picked up over the course of the last year or so, but at 4.1%, it's still historically very low. Of course, we have distortions around the pandemic. But the blue line is what we look at on a week-by-week basis. This is a good leading indicator, really, of the underlying economy. And you can see that initial jobless claims have actually been running at a very low level. There was a small pickup during the dreadful hurricanes in Florida, but you can see this has ticked back down again. And this is indicative of a labour market that is doing still very well, weakening at the margin, but nonetheless holding in. And that clearly is a positive for future growth in the US. So turning to our second point, Treasury yields have been moving up over the last few weeks. You can see the chart I'm showing you here. The red line is US Treasuries, and you can see how yields have moved from roughly 3.6% to about 4.3% today. So quite a meaningful move higher. Why is that? Well, it's related to what I was just saying. The economic numbers have been coming out better than expected. But of course, there's also an element of promises coming from both presidential candidates. Both Trump and Harris have been speaking about more spending at a time where the deficit is already at an extremely high level. So I think investors are beginning to say, you know what, we need a little bit more premium in order to lend the US government money. The other element is the blue line here. This is looking at market pricing for Fed rate cuts by the end of next year, 2025. And you can see that also has moved up. So in other words, investors are no longer expecting quite the same amount of rate cuts because of that better growth dynamic that we're seeing. Now, ultimately, we think that is likely to move down a little bit as we get through the election period. We think bond yields are a bit above fair value, but nonetheless, we're expecting a period still of volatility over the coming weeks. Now, turning to our third point, equity markets to us are showing signs of tiring. There's a bit of profit taking coming through. As you can see by the chart here, and we've mentioned many times, we believed that we were in a fairly deep-rooted bull market. But nonetheless, when you look at the various equity market indices in the United States, there are some signs that they're beginning to roll over just a bit. Whether it's the Russell Small Cap Index or equally weighted S&P 500, you can see that actually it hasn't done much for the last number of weeks, and it's beginning to show signs of tiring and rolling over. Even the red S&P 500 here, you can see a similar dynamic. And importantly, the blue line, which is the tech-heavy NASDAQ, it only just managed a few days ago to breach its highs from the summer, but there's been no follow-through in that. It shows sign of getting just that little bit tired. And of course, as we come up to the election in the coming days, there's a good chance we'll see more volatility. So as a result of that, we suspect that there's a need to be a little bit cautious given the market here. We wouldn't be surprised to see a bit of a pullback before ultimately we move a bit higher. Now remember, as always, you can read the full report on Zurich.com, and we look forward to speaking to you next month, where hopefully we'll have a clear result in terms of the US election.